everybody. Welcome back to another segment of Markets Mindset. I'm here with Moshe Tomkiewicz, head of Mizuho's debt capital markets here in the U.S. Moshe, it's the middle of October. Third quarter's in the books in the IG capital markets, and we are staring down a very important presidential election just 3 weeks away and another Fed meeting. They just went 50 basis points. A lot of things going on in the world as well geopolitically. We just hit another post-financial crisis tight. Tight spreads on the index during the last, 16, 17 years. Why are we where we are?
There's a couple things at play here, Victor, but, I'd first start off, and I'm sure you would agree with me as a syndicate professional, that this is the best liquidity backdrop I've seen in my entire career. So, like I said, there's a couple things at work here. You got the central banks easing, so that's a headwind into a tailwind. You got China throwing the kitchen sink at its property crisis, and you have the U.S. economy that's still flexing some serious muscle. I think the Atlanta Fed, their current estimate of Q4 GDP growth is still north of 3%. And then on top of that, you still have a mountain of investable cash still sitting on the sidelines. I heard one large money manager quantify that as in the context of about $23 trillion when you add up money market balances and bank deposits. So you have a massive liquidity well on top of improving fundamentals and technicals, and that sets up this type of liquidity wave we've seen in the market. So what has that generated? Well, in equities, I think as of last Friday, we hit our 45th record high for the S&P this year. There's been 199 trading days in the market this year. So that means we hit a new record high once a week. And in credit, we've had close to $7 trillion of demand just for IG dollar product. So we're seeing just the manifestations of the liquidity that's out there. And now the central banks are pushing on it. Now we're having fiscal initiatives in some parts of the world pushing on it. So even though we've hit record tights in spread product, I still think the path is set for us to go tighter, potentially considerably tighter.
The bid for duration still goes on, even though we could argue with the way rates have moved post the Fed 50 basis point easing, which has been higher in the long end, that maybe that's not the right move, but that bid for duration is still there, isn't it?
Yeah, they're just trying to lock it up. I mean, I'll tell you, Victor, one of my big concerns is that when you have this type of liquidity, then you run the risk of asset bubbles. And I'm thinking about asset bubbles in risk assets specifically, in equities and even in our product. I mean, if you look at our product, one of the gauges I look at in terms of risk appetite is the basis between high yield and IG. All right. Right now, we are basically at record tights, and there's definitively fat tail risk that remains out there in the market. We've spoken about geopolitics so we're blue in the face. We can't dispute the fact that the current backdrop in the Middle East is one of the most dangerous I've seen in decades. We have an election less than 3 weeks away, which is completely deadlocked right now. And this market is very prone to sweep risk on both sides, right? But when you have this type of liquidity, it tends to minimize those risks until those risks get to the place where you can't ignore them. And that's one of the things that does concern me.
I mean, it's interesting, Moshe, you talk about bubbles. I mean, I sit there and I look at, while we worry that this demand bubble for IG capital markets bursts, I still think about what would cause that to burst. That could be a rapid move down in rates. But if you get a rapid move down in rates, what's going to happen to all the short-term cash? What was it? You've mentioned over $6 trillion of cash sitting in short-term money market accounts, which, at least for the last 2 years, has actually been earning interest. It's been a decent amount of income. If that starts to go the other way and the curve either normalizes and front-end rates do come down for whatever the reason, I could see some of that cash looking to push out for opportunity as well. Could you not, to support the longer-term bid?
I do. Listen, when I think of kind of the primary risk, the kind of this bubble narrative, the thing that pops immediately in my head is the bond market, but for a different reason than you're looking at it. Because if I see a material rally in term rates, right. That means something went haywire. And assuming that haywire isn't something that's very inflationary, the market knows the Fed has its back. Right, so that'll limit that damage.
Do you think the market still has the Fed put at their backs if something goes wrong in the world?
Yeah, I do, because that's basically what we've heard from virtually every Fed speaker post-CPI, that they didn't love the number, but they stand at the ready in the case that we see a real hiccup in labor to jump in.
So, Moshe, we're in the middle of blackouts right now, middle of October. So supply is down. A lot of people got their funding done early. Some even pre-financed 2025, which is still going to be a big year in terms of refinancing needs of maturities, much bigger than it is this year, even with the pre-funding that's gone on. Post-election, early November, post the Fed meeting, early November, what are you telling clients about the fourth quarter here?
I said stand at the ready. Look, Victor, and you know this, our fundamental call at Mizuho is that the neutral rate is considerably higher than the Fed has said it was. So specifically, Steve Rasciuto has set 4% is the neutral call. And if he's close to right, and he's been seeming pretty right so far, then even at 4%, the 10s are a sell from an investor perspective as a buy for an issuer. So I still like rate locks because I think when I look at the market, I think spreads are going tighter, but especially for our higher quality clients, I think your cost of funding is going higher. Right. But one thing I have been spending a lot of attention on is actually the international markets, because with the U.S. economy doing what it's doing, and more importantly, with the European economy doing what it's doing, which is almost polar opposite than what we're seeing in the U.S., then you're seeing a growing basis differential between funding costs in Europe versus funding costs in the U.S. To be specific, the current gap between 10-year treasuries and 10-year bonds is 180 basis points. That's 30 basis points higher than it was at this time a month ago. But you have the ECB later this week. If they come out with a more dovish than expected narrative, then you could see the market really start taking a run at that 220 level that we saw in April. And I think for multinationals who have a wall of COVID debt coming due in 25 and 26, that is going to be a very relevant market if our view in the U.S. turns out to be right.
Having said all that, I know we've talked about this a lot, not getting political, Trump-Harris win. What are you looking for from the election that could cause this market to get roiled? What's the outcome?
A sweep by either party is a market negative. A divided government will be a market positive. And I think the market right now is pricing in a divided outcome.
So as long as we have a divided outcome, you feel pretty confident there's going to be financing opportunities post the election?
Yes.
Okay. So Moshe, we've spent most of our time here at a more macro general level about the IG markets. Let's just get into something a little specific that I think is a hot topic this year with the changes that occurred last year from Moody's in particular, but hybrids. Give you some background stats. Last year, $33 billion worth of hybrids came to market. Of that 33, $5 billion, maybe a little over $5 billion, was from non-financials. In 2024 year-to-date, $71 billion of total hybrids, 5 times the number of non-financial hybrids, $25 billion, most of them coming from the utility space to fund CapEx, large CapEx expenditures going forward here over the next 4 to 5 years. What are you seeing from other non-financial borrowers, and where do you see the use of hybrids going forward right now? Not just in the utility space to fund CapEx, but where else are you seeing the interest and the thought process around using them?
Victor, I think where we're starting to see some applicability to it is in, at least in the corporate space, is in deleveraging situations. So in some of the situations specifically we've been working on, we've had some clients who've done some material M&A, deleveraging for a number of different reasons hasn't happened as quickly as they anticipated. So they're looking at a situation where they buy back debt in the market and fund that transaction with hybrid capital. So you're basically raising 50 cents of debt to take out every dollar of debt in the market. So it's a way of essentially turbocharging that strategy. I'm seeing non-traditional hybrid users really start to get engaged in that product. What do you think the demand profile is going to be like? Is there going to be sufficient demand to absorb that?
Well, it's interesting because we're sitting at subordination and extension premiums at some of the lowest levels we've seen of all time, meaning accounts are willing to buy them as tight versus senior debt as they ever have been. And that usually would be something that would contradict demand being there from investors. You'd figure at the tights they wouldn't be there, but the need for yield in people's portfolio, the desire to lock that yield in, especially if you think you have the Fed put, or you think the Fed's going to eventually have to lower rates and rates will follow. That product has seen, and I think we'll continue to see demand in it. The question is what the levels are going to be, right? We've had deals approach breaking the 6% initial yield threshold. We haven't had one non-financial go through just yet. And with this rate back up post the Fed, it's going to be interesting to see where we come out. But there have been changes, right? The Moody's tax deductibility was a big change last year. And then, of course, recently we've had a couple of deals. One of the few things that has changed is some new options for issuers. We have deals that now can put floors on the reset, which make investors a lot more comfortable with the extension risk going forward. It's increased demand. It's lowered coupons by anywhere from 25 to 50 basis points. So it's another arrow in the quiver of issuers on how to structure their hybrids that I think are very investor friendly, that can keep this party going in terms of demand for hybrid. But look, Moshe, we've talked a lot. Spreads at their tights post-financial crisis, new issue premiums at almost flat to maybe a handful of basis points, oversubscriptions at relative highs versus last year, and the ability of dealers, of syndicate desks, to move deals from their original IPT to their final price has never been greater. We're nearing like 30 basis points of average move. That we're priced for perfection right now, and I guess we're going to see where it goes over the next couple of weeks and what happens after the election, the next Fed meeting. And we'll be back during a holiday edition, I guess, to go through everything that's gone on since this meeting.
That sounds like a plan, Victor.
You got it. We'll see you next time on Markets Mindset.